Good evening. It's not coming? Okay. Yes. Good evening. My name is Satyajit Ghosh. I teach economics at the university. On behalf of the economics department, Omicron Delta Epsilon, it is my great pleasure to welcome you to the 24th annual Henry George Lecture at the university. The lecture series, which is named after the 19th century economist and philosopher Henry George, who was born in Philadelphia, started in 1986. Henry George was most well known for his treatise on inequality, progress and poverty, and his idea of single tax on land. Robert Schachenbach Foundation was established in 1925 to promote the ideas of Henry George. In early 1980s, we received a grant from the Robert Schachenbach Foundation, and it is their generous support that makes this lecture series possible. There are some members from the board of the Schachenbach Foundation. They're here, and we thank them for their continued support. The lecture series, which has grown to be a preeminent public lecture series in economics in northeastern and central Pennsylvania, as I said, started in 1986. When we began in 1986, little did we know that even 24 years after that, we would be welcoming you to an event like this, and we would continue to have speakers, the distinguished speakers, who would come to the university year after year to share their vision, to share their wisdom with you. And it is the speakers to whom we owe our greatest debt, because without them, we would not be having this lecture series. And what a distinguished list of speakers we have. The list of speakers includes 6 Nobel laureates. 6 of our former speakers won Nobel Prize in economics, with the most recent one, Paul Krugman, who won Nobel Prize in 2008, and going backward, Joe Stiglitz, George Akerlof, Amartya Sen, Robert Lucas, and Robert Solow. And it's not just the Nobel laureates that we had. We had four chair of the Council of Economic Advisors. Again, starting with the current chair of the Council of Economic Advisors, Christina Romer, who came here in 1999. And again, going backwards, Greg Mankiw, who was the chair for President Bush, Joe Stiglitz, who was the chair under Clinton administration, and Charlie Schultz, who was the chair for the Council of Economic Advisors under President Carter. And not just the Nobel Prize winner, not just the chair of the Council of Economic Advisors, we have been really fortunate to have perhaps the best minds in economics to come again year after year to the campus. Tonight's speaker, Brad DeLong, is no exception. Brad DeLong was educated at Harvard, joined the University of California at Berkeley, and before that, he taught at Harvard. He became full professor at Berkeley in 1997. And before that, he worked in the Clinton administration as the Deputy Assistant Secretary for Treasury for Economic Policy, where he worked on the '93 Clinton budget, the healthcare reform that he tried, the Uruguay round, NAFTA, and many other macroeconomic policy initiatives. Brad DeLong has written numerous articles in economic history, economic growth, business cycle, finance, and many other areas of economics. Actually, as a young economist, when he first started his professional career, Brad DeLong took up a very accepted, at that time, it was a very accepted idea of economic growth, and proved that it was not really that sound a conclusion that you can arrive at by applying insightful analysis and terrific statistical work. Since then, DeLong has applied his insightful analysis in vast areas of economics, challenging existing ideas, providing new ideas. He shaped many different parts of economics, as I said, starting with economic growth, for which perhaps he is most famous for, but not limited to that. A few months back, when we first started to think about who we should invite for this year's Henry George speaker, we wanted to focus on the public policy issues of current period. Henry George, although he was known for single tax on land, perhaps if we step away from his proposal on single tax on land, what Henry George was passionate about was public policy issues. That's why he was not limited to only a single tax on land. He dealt with issues on monopolies and taxing monopolies. He dealt with issues on immigration. He dealt with issues on free trade. So over the years, we tried to stay true to the spirit of Henry George by organizing a lecture that would be truly a public policy-oriented lecture. And Brad DeLong, in spite of his tremendous academic achievements, in spite of his public policy role in the Treasury, perhaps is most well known for his website, for his blog, grasping reality with both hands, where he provides fair and balanced approach, not to be confused with the signature of a newscast of some questionable network. So when we wanted to invite someone this year, the choice was pretty clear-cut to us. Brad DeLong, because of his background in economic growth, because of his work in business cycle, because of his background and work in finance and economic history, seemed to be a natural choice for us. And one more thing. Since 1970s, perhaps, we haven't seen a more heated debate among economists about macroeconomic theory and macroeconomic policy that goes with it. But while intense debate, while heated debate is always welcome, unfortunately, what we are seeing more and more that reasoned arguments, reasoned voice are kind of subdued by shrill of personal animosity and political banters. When logical analysis is giving way to illogical rancors, perhaps more than ever, we need the reasoned, the fair and balanced and insightful analysis of Brad DeLong. So ladies and gentlemen, I give you the 24th annual Henry George speaker, Brad DeLong.
Thank you very much. Let me start by seeing if I can arrange all the machines I was hoping to look at up here. And I suppose, let me see if I can pull something down from the internet. Only because that looks like a better place to look for it. And yes, looks good. Good so far. Come on. Nope, not so good. Yes, that looks considerably better. Okay, now we have at least what I wanted to take a look at least on this screen. And now let me open up this one. So I can take a look at an entirely separate set of notes as well. Bingo. Yes, excellent. We stand here in the middle of the worst downturn of the post-World War II era. We stand here in the middle of the worst episode of economic distress that has been seen since the end of World War II. And it is in some ways very strange that we stand here, that we didn't expect to be standing here. We thought 2 years ago that we knew well enough how the world economy worked that we weren't going to get to the largest recession, to a quasi-depression, to an extraordinary episode of economic instability, and yet we have. So the first question that I want to talk about tonight is how we have managed to wind up here in this peculiar, unusual, and most of all, extraordinarily unexpected situation. How is it that we've wound up in something that, although it's not a Great Depression, is a close cousin to it? And second, I'm going to want to ask, what can we do about it? What should we be doing that we're not doing? How should we be dealing with the current crisis in a way that we're not dealing with it? How can I get this right? A little bit higher. And can we see this well enough? Oh yes, we can. It looks better on this screen. How is it that we've gotten ourselves into a situation where we have this large plunging spike on our graph at the far right as the U.S. economy has headed into deep recession, as the employment to population ratio in America has collapsed? For we are now in the worst recession of the post-World War II era, making this a very bad time to be entering the labor market or losing your job and looking for another one in the United States, and also a very bad time to be entering the labor market or losing your job anywhere else in the world. For as demand in the United States has fallen, the United States' role as the global economy's importer of last resort and safe haven for finance has meant that its recessions carry the whole globe right down with it. And this is also a very bad time to be a macroeconomic theorist. Take practically any economics textbook. Try to use it to figure out what's happening in the world outside right now, and you come up pretty dry. Take any introductory economics principles text. It is not of much greater help. Perform the difficult and arcane task of reading the technical papers that we make graduate students read in their first and second years of macroeconomics courses, and you gain little of use. That the economic theories we professional economists have been typically teaching over the past decade do not do their job of helping us to understand the world in which we are now living. Now, in part, this is because the current global recession is a very different animal than the other recessions of the post-World War II world that we had grown used to. In the textbooks, at least, since World War II, global recessions had been caused, or at least courted, by the actions of North Atlantic central banks. The Federal Reserve, the European Central Bank, the Bank of England decide that monetary policy has been too stimulative, too lax, that supply shocks have carried the prices of natural resources upward too high, that there is great danger of a very damaging global inflationary spiral, and that as a result, we need to shift policies from putting first priority on maintaining employment to first priority on maintaining or recovering the credibility as guardians of effective price stability. And when central banks decided to make their price stability mission their highest priority, they sold safe treasury bonds for cash. Thus, they shrank the amount of cash in the economy, increasing the duration of the assets that the private sector must hold, and decreasing how much assets those impatient to spend could hold and feel safe. And as a result, spending fell, and as spending falls, unemployment rises, wage and resource prices stop rising or fall, and the threat of an inflationary spiral falls away. The central banks have, in the words of William McChesney Martin, chair of America's Federal Reserve Board from 1951 to 1970, taken away the alcoholic punch bowl before the party gets going. According to my Berkeley colleagues, David Romer and Christina Romer, both of whom you've seen here, this type of recession courting recession, triggering shift in priorities on the part of the Federal Reserve Open Market Committee, it's the cause of 6 of the 9 post-World War II recessions. The first 6 big downward movements in the employment to population ratio since World War II that we see in this graph here. However, they say the last 2, when they were writing, the last 3 now, the last 3 are different. They don't have their origins in a central bank decision that it's time to change priorities and fight inflation. Instead, they have their origins in an endogenous collapse on the part of financial markets in their confidence, in their willingness to hold risky assets. A few very rough numbers for where we are right now. 26 months ago, we had in the world roughly $80 trillion of global financial assets. Today, we have roughly $60 trillion on net of traded global financial assets. We can summarize the determinants of financial asset values as the result of 5 forces. Par values, that is book or construction values, and then 4 discounts, some discounts for default, duration, risk, and information. The default discount is your counterparty might simply not pay you. You might go to them and say, you owe us money, and they might say, tough, we can't pay. The duration discount is that money in the future, even certain money of insured purchasing power in the future, is not worth cash in hand today. The third discount, the risk discount, is perhaps when you get your money, it will be a state of the world in which your marginal utility of wealth is low. And so you really don't care that much that you've got your money. Or worse, that you will lose your money in a state of the world in which your marginal utility of wealth is high, in which case you feel the pain really strongly. And fourth, perhaps you lack information. Perhaps your counterparty knows something important about the asset that you do not. If it's such a good idea for them to sell it to you at this price, why is it a good idea for you to buy? Situations in which you don't know as much about your counterparty are situations in which you should apply deep discounts to your valuations. For as Sky Masterson's father told him, that, son, someday someone will come up to you with a deck of cards fresh from the factory, still in its seal, and bet you that he can make the Jack of Diamonds jump out of that deck and squirt cider in your ear. Son, when the man does this, do not take this bet. That's the fourth of these discounts. Now, Of the $20 trillion decline in the value of global financial asset values we have seen during this crisis, only a small part, 1 trillion to 2 trillion, comes from increasing default discounts on the driving factor behind the crisis. Losses on mortgages and mortgage-backed securities made on homes overbuilt in the desert between Los Angeles and Albuquerque due to irrational exuberance in global housing markets. There are perhaps another 4 trillion in other defaults springing from the fact that because the global economy is in recession, other companies are failing and won't pay their debts. But were there no recession, those losses wouldn't be there. And those losses have been offset by $4 trillion that should have been gains in global financial asset values because central banks have flooded the zone with liquidity, have done everything they possibly can to push asset prices up, and have only managed to neutralize the 4 trillion loss due to increases in defaults. The net effect, increases in risk and information discounts account for 90% of net global financial asset losses. The first order factor in our crisis is not its trigger. Its trigger was overinvestment in housing or default on mortgage-backed securities, but that has created a situation in which all over the world investors and financiers are terrified of holding risky assets, and thus a situation in which businesses that could normally seek to expand find they cannot get financing on terms that make expansion profitable. And that is the source of our problem. Now, how has the economics profession reacted to this kind of particular coming crisis? Well, earlier today, I talked about the 4 factions currently active in modern policy-oriented macroeconomics in the wake of the collapse of the world economy, and of reality's rude disproving of economists' smug confidence that they had learned enough about economic policy to finally stabilize the world economy, to finally create the great moderation. And even I was told I should push my afternoon and evening talk as far apart as I could, because a bunch of people who came to the afternoon one would also come to the evening one. Over the past week, the two have crept closer together. So let me try to briefly summarize a lot of what I said earlier this afternoon at much shorter length. But for those of you who are bored because they were here this afternoon and paying attention, my apologies. Feel free to go to sleep for about 10 minutes. So there were 4 factions. The first faction called them the Greenspanists, because they had been riding high while Alan Greenspan was chairman of the Federal Reserve Board. The Greenspanists believed the Federal Reserve should focus on pumping up demand to keep employment as high as possible without running any significant risk of an inflationary spiral, and that the government should furthermore rely largely on investor self-interest. In order to minimize fraud and excessive leverage, and if the relatively expansionary monetary and the hands-off regulatory policies of the Greenspanists, if they led to a bubble which then collapsed, well, the Federal Reserve had the tools to step in and contain the damage, keeping disruption in financial markets from spilling over to the real economy and causing mass unemployment. That after all, there had been financial crises or near financial crises in the United States in 1987, in 1991, in 1998, and in 2000. The Hayne-Leland collapse of portfolio insurance collapse of the stock market in one day is the first. The savings and loan crisis is the second. The bankruptcy of long-term capital management is the third. And the collapse of the dot-com bubble is the fourth. And in all 4 cases, the Federal Reserve stepped in, cleaned up the mess, and kept there from being any significant shift in the amount of the American population that was at work. Right? The recessions that followed these crises or near crises were either non-existent or were short and shallow. And the Greenspanists argued that all that happened was we simply had bad luck this time. That policies were sound, we were just terrifically unlucky. We're not going to be that unlucky again. We should continue with business as usual. Unfortunately for the Greenspanists, they appear rather weak now because Alan Greenspan is staggering around saying that he has misjudged the economy and that he himself needs to rethink what he believed. So those people who are still on his side are facing a kind of absence of banners to follow. So one faction are these Greenspanists. Second faction is the people I call the punch bowlers. After William McChesney Martin's statement that the Federal Reserve exists to take away the punch bowl before the party really gets rolling, as opposed to Alan Greenspan's doctrine, which is that as long as there's no big inflation, who cares what's happening to asset prices? That as long as there's no inflation on the consumer price index, the Federal Reserve can spike the punch bowl with the grain alcohol of low interest rates and excessive monetary expansion as much as it wants to and let the party get really wild and exciting. And if things turn out badly afterwards, well, the Federal Reserve exists as designated sober driver to drive everybody home. The punch bowlers do not believe this. They believe that under normal circumstances, investors' self-interest and due diligence would properly minimize fraud and excessive leverage, but that excessively easy monetary policy and excessively low interest rates are a temptation no financial market can exist, are a source of irrational exuberance. Hence, they say the big mistake was in making monetary policy be too loose, in trying to pursue full employment too aggressively. That in the future, whenever the Federal Reserve considers monetary policy, it must not just ask, should the unemployment rate be a little bit lower? It should also ask, can financial markets take another reduction of interest rates without running a risk of a bubble? And if they say no, they cannot, then the fact that unemployment is higher than in some sense should be is bad luck, but there's nothing we can do about it. It is our karma. The third school of thought, the producerists, of whom Henry George would definitely have been one were he alive today. That is, the rewards to financial speculation today would arouse the same suspicion in him that the rewards to urban real estate speculation on the lands lapped by the waters east of the Golden Gate and north of the Verrazano Narrows aroused in him in the 19th century. The producerists have yet a third view. That they say finance has a whole bunch of functions for which it needs bonds, stocks, plain vanilla mortgages, savings accounts, checking accounts, credit cards, but that everything else is pointless. At best, it's a zero-sum casino, a kind of non-glitzy, non-pretty equivalent of Las Vegas. At worst, finance is an extraordinary dissipation of national wealth and a cruel hoax on many of the customers of the financial sector who are made to bear risks that they have no business bearing and are made to bear such risks by not understanding what they are doing. And it needs to be tightly regulated both for the sake of customers in normal times and for the sake of us all in the aftermath of financial crises. As the head of the producerists at the Federal Reserve, the late Governor Ned Gramlich said to Alan Greenspan back in 2003, that all of these homeowners buying homes on subprime mortgages in the desert outside of Los Angeles are being made to bear enormous risks of interest rate changes. And they have no business bearing such risks. The financial markets should not be allowing them to do so. These particular contracts are not contracts they should be signing. To which Alan Greenspan responded, how long is the Federal Reserve likely to stay an independent institution if we could pick up lenders who want to lend and borrowers who want to borrow and move from two-bedroom apartments in Venice Beach into four-bedroom houses in San Bernardino? If we step in and say, we don't care that you want to lend and you want to borrow, we're the Fed, we're the government, we're not going to let you. A fierce potential debate carried on largely in private in the run-up to 2007, which has changed substantially since it all came crashing down. And when it did come crashing down, Greenspanists, punch bowlists, and producerists all, however, agreed that the current crisis called for extraordinary and stimulative policy measures. that normal monetary stabilization policy by the Federal Reserve via open market operations, controlling the money stock by buying bonds for cash when it wants spending to rise and selling bonds for cash when it wants spending to fall, are not equal to this crisis. Therefore, we need an appropriate and well-implemented mix of extraordinary policies, a host of stimulus programs, using quantitative easing to banish any fears of possible future deflation, using banking sector recapitalization to raise the private sector's diminished risk tolerance and make banks willing to hold more risky assets, providing government guarantees and having the government purchase assets to reduce the burden of risk the private market must bear, and running larger government deficits in the short run, fueling direct government spending to try to reduce unemployment as well. And these three factions fight fiercely among themselves as to what appropriate mix and well-implemented means, but they are as a group opposed by a fourth faction that has appeared over the past year, those who will have none of such extraordinary stimulative policy measures. I don't yet have a good name for them, so I'm choosing a derogatory name, and I'm calling them the nihilists, because they're saying no to the extraordinary policies that everyone else thinks are desirable at this stage. And also, when I try to get them to explain their arguments, they seem to say no as well. They don't come up with anything that I regard as especially coherent. And they believe there's no point to special banking sector policies. Quote, "This bank bailout issue," one of them wrote, "I really don't get it. The right public policy is some sort of accelerated bankruptcy proceedings. Just to say to make the banks well on all the money they've lost over this thing, I do not get it. And would a fiscal stimulus add another weapon? If the government builds a bridge and the Fed prints up some money to pay the bridge builders, that's just a monetary policy. The only part of the stimulus package that's stimulating is the monetary part." And earlier today, I said I thought the nihilists were going to lose the intellectual debate, and rapidly disappear. But they have placed too many empirical bets that the Federal Reserve was unwarranted in its panicking for no good reason in the summer of 2008, and that the extraordinary stimulative fiscal and banking policies in the US and elsewhere in 2008 and 2009 will have absolutely no effect, they said. And those reputational bets are going wrong, and they'll be seen to have gone wrong. And the theoretical arguments, as I said before, they are incomprehensible to me at least, and not just to me. That let me quote Carl Smith of UNC Chapel Hill on two of the nihilists, right? Eugene Fama and John Cochrane. Quote, "Beginning with Eugene Fama's arguing the stimulus could not work, I have been deeply puzzled. The probability that I understand macro on a deeper level than Fama or Cochrane is low, yet it seems to me that basic error is being made by assuming that increases in the demand for money do not reduce, right, the quantity of transactions. Yet, given the premise that it is unlikely I understand something Fama and Cochrane do not, the logical conclusion is that I am missing something. And I share Carl Smith's worries. That is, those I have termed the nihilists are not stupid. They include at least two past Nobel laureates, and I suspect at least one future one. And 2 years ago, I'd have said they contain much more than one future one. So to put my worries at ease, I need to have a theory of where the nihilists are coming from and why they are so wrong. So let me now pick up the thread that I dropped earlier this afternoon, that the people who came before can wake up, because I'm going to say something new. And let me detour for a minute or two to sketch my view of the origins of the school, and to justify my decision to, by and large, ignore what they have to say for the main lesson of my talk, which is about the lessons for future macroeconomic policy from the crisis of 2007. I guess we now have to say 2007 to 2010, don't we? It's pretty clear this is not going to be over by 2009. Back when we first started talking about it, it was the financial panic of 2007. Then it was the crisis of 2007-8, then it was the Great Recession of 2007, 2009. And I kind of hope we'll still be calling it the Great Recession of 2007, 2009 at this time next year. I don't want to live in a world in which we're calling it something else. If you ask a modern economic historian, like, say, me, what is going on right now? Why is the world currently in the grips of a financial crisis and a deep downturn? I will say that I have a rough guess and some substantial knowledge of the answer, and I'll give you this answer. I will say that this is the latest episode in a long history of similar episodes of bubble, crash, crisis, recession, dating back at least to the canal bubble of the early 1820s in Britain, to the 1825-6 failure of Pohl Thornton and Company, and to the subsequent first industrial recession ever in Great Britain. I would say we've seen this process at work in many other historical episodes as well. 1873 with the collapse of the U.S. investment bank of J. Cook and Company, 1890 with the first Baring Brothers crisis, 1929 and 2000 with the collapse of the dot-com bubble. And that for the reason is that for any one of a number of reasons, asset prices get way out of whack and rise to unsustainable levels. Sometimes the culprit is lousy internal controls in financial firms that over-reward subordinates for taking risk, as in the employees of Baring Brothers, who were supposed to sell Argentinian bonds on the London Stock Exchange, but decided since they couldn't get what they regarded as high enough bonds for the high enough prices for the bonds, that they would keep them in the bank's portfolio instead. Right? Big mistake. 6 months later, they would have been glad to have sold the bonds at any price, but they couldn't. Sometimes it is government guarantees that convince financial businesses that really ought to be more cautious to kind of swing for the fences, and financial businesses that are already in trouble to gamble for resurrection. That is, if the government's already paying, and if you're already broke, then why not gamble? After all, heads you win, tails the government pays. That's the story behind the U.S. savings and loan crisis of 1990. Sometimes it's the selection of the market as a long run of good fortune leaves the financial market dominated by cockeyed, unrealistic over-optimists. They, after all, were the ones who were long and leveraged risky assets, and when risky assets go up, they profit and have much more money to make the next round of bets. While the sober or the pessimistic, who were short or neutral, well, they've lost all their money. They're no longer there. Plus, in addition, you have the destabilizing factor of people on the sidelines watching other people who are no smarter than they are, and certainly no more harder working than they are, getting really rich. As my teacher Charlie Kindleberger used to say when he gave this version of his talk, he would say, there is nothing more disconcerting, disturbing, and deranging of your own mental state than to see your friends become fabulously wealthy. And in Manhattan, he'd always get a laugh, and it would always be a nervous laugh when he said this. Then the crash comes. And when the crash comes, the risk tolerance of the private market collapses. Everyone knows that there are immense unrealized losses in financial assets, and nobody is sure they know where they are. Thus, the crash is followed by a very large flight to safety. No one wants to hold their portfolio in risky assets. Everyone wants to hold their portfolio in safe assets. The flight to safety is followed by a steep fall in the velocity of money, as investors everywhere ask, what's the safest asset of all? Cash. What should I do with my cash? Well, I should hold on to it rather than spend it. When cash is no longer something burning a hole in your pocket so that you're anxious to spend so that you can get some use out of it, either spend it on some consumer good or trade it away to someone else so you can invest in some higher yielding investment. If you think all the higher yielding investments are too risky, you'll hold on to your cash, you won't spend it, and then total spending will fall. And when total spending falls, the employment to population ratio does the dance it went at the far right of the graph I put up at the start. Now, I won't say this is the pattern of all recessions. It isn't. But I will say that this is the pattern of this recession, and it's a pattern that by now we ought to be familiar with because we've seen episodes of it since 1825. We have been here before. And that's the economic historian story. If, by contrast, you ask the same question of a modern macroeconomist, like, say, the extremely sharp Narayana Kocher-Lakota of the University of Minnesota, you'll find that he says that he does not know. Quote, why do we have business cycles? Why do asset prices move around so much? Macroeconomics has little to offer by way of answer to these questions, unquote. He will say there are various models that attribute economic downturns to various causes. Quote, most modern models in macroeconomics rely on some form of large quarterly movements in the technological frontier. Some have collective shocks to the marginal utility of leisure. Other models have large quarterly shocks to the depreciation rate in the capital stock in order to generate high asset price volatilities, unquote. Now, who understood that? All right. What Narayana Kocher-Lakota is saying is that people who build complicated theoretical models in which everyone's income adds up and all of people's decisions are consistent given the information they have, find that they have to do one of three things to their models to both generate a model that they can solve and analyze on the one hand, and generate a model with big business cycles in it on the other. They can get a significant downturn if they impose on the economy a great forgetting, that people suddenly just forget how to do things. They forget 3% of their ability to produce. They forget 3% of their technological and organizational knowledge. So the same amount of capital and the same number of workers are all of a sudden producing 3% less. That's how they can start a business cycle. They can produce a business cycle if they impose on the people in their model a great vacation, a sudden extra taste for leisure, say a model of the Australian economy in which everyone all of a sudden learns to surf. Or they say they can get a big recession, and one that looks rather like this one, if they impose a great rusting on the economy. If they say the speed with which oxygen in the air corrodes large things made of metal all of a sudden speeds up so that every piece of capital equipment rusts much, much faster. That's what they have to do in order to produce models that match current say, standards for consistency, and yet also produce large fluctuations. But Narayana Kocher-Lakota will then go on to say that all these strike him as implausible just-so stories that do not illuminate much, as not to be taken fully seriously, quote. That the sources of disturbances in macroeconomic models are, to my taste, patently unrealistic. None of these disturbances seem compelling as descriptions of the world, to put it mildly, unquote. And further, that nobody really believes them, quote. Macroeconomists use them only as convenient shortcuts to generate the requisite levels of volatility in endogenous variables. Who understood that? All right, this really is Narayana's, and to some degree my native dialect by now. That sentence doesn't sound odd to me at all after 30 years in this business. What he means is that imposing these peculiar things on your model is the only way to get them to behave consistently and still produce large fluctuations in employment and production, like those that we saw in the figure, right, I'd put up. So this is a problem. And so what do you do if you're a modern cutting-edge macroeconomist and you must somehow produce an opinion on a question of what public policy should be? Now, some people take their models very seriously indeed. Thus, we have Ed Prescott of Arizona State saying he really does believe that big recessions are the result of a great forgetting or something similar. For example, he says the reason the world went into a Great Depression was because of, quote, Herbert Hoover's anti-market, anti-globalization, anti-immigration, pro-cartelization policies that disrupted the ability of the market to produce. And Casey Mulligan of the University of Chicago is indeed writing in the New York Times last fall that if we were in a recession, it would be because of all the things the government would do to make it less rewarding to work. Like the fact that if you quit your job, you can then get a better deal on refinancing your house. Now that doesn't account for 5% of the American population suddenly finding themselves without jobs. Right? You go out across America today looking for someone who quit their job and hasn't looked for another one because they'll get a better deal on refinancing their house if they're poorer. And they'll say, no, that's really not what they're about. But no most are with Coach or Lakota. Right, to say that Alan Greenspan at the Federal Reserve and Herbert Hoover were the most destructive anti-market interventionist policymakers ever, and that's why we have such big recessions under them, really doesn't pass a laugh test. The current recession is not because government has suddenly and materially stepped up the pace of its destructive anti-market interventions. The current recession is not the result of a great forgetting, it is not a great vacation, it is not the result of a great rusting. So what do you do if you believe in cutting-edge macro, yet do not take your cutting-edge models to be well enough developed to be guides to policy analysis? And one possibility is to return to older non-cutting-edge models that people nevertheless used for policy analysis in earlier days. To go back to the history of economic thought and pull things off the shelf, blow off the dust, polish them up, and still, if they say, deal work. Return to Irving Fisher's quantity theory, to Milton Friedman's quantity theory, to Knut Wicksell's market and natural rate of interest, which I once saw Alan Greenspan terrify 8 congressmen by deploying those concepts unexpectedly in the middle of a hearing. To John Hicks's ISLM model and its many new Keynesian descendants, and so forth. And that's what the economists who are Greenspanists, producerists, and punch bowlers discussed above do. The nihilists are those who have closed this door. A second possibility is to use your knowledge of past history to draw analogies and make inferences. That is, I think, much of what Christy Romer of the CEA and Ben Bernanke at the Federal Reserve do these days. Indeed, it sometimes looks better to have not a model of the financial crisis, but instead knowledge of past financial crises and an ability to make analogies on the fly. At least those people who do this appear to be more coherent and to have more credibility than others in meeting these days. Last week at the Economic History Association, Charlie Kindleberger from Columbia, Charlie Calamiris from Columbia, talked about how he wins every meeting in Washington now by saying, well, my recollection of the Overend Gurney crisis in 1866 is such and so I don't think that would work. And he says it's kind of like he holds trumps, that every word that comes out of his mouth is a trump because he's the only person in the room who knows the financial history. But this door is closed to the nihilists as well. Eugene Fama, for example, is a man who has never read the Hyman Minsky line of research book, Manias, Panics, and Crashes, that Charlie Kindleberger, my old teacher, wrote, which is the best book ever written on financial crises and their macroeconomic implications. Fama is, he says, unfamiliar with that entire line of work, which shuts off the argument from historical analogies. The third possibility is to try to roll your own analysis from first principles, whatever those may be, without reading the relevant literature, and indeed often without knowing there is a relevant literature. And the natural consequence is that you make what can only be called mistakes, obvious mistakes, to my mind, mistakes that were identified such in the 1920s, if not earlier. Thus, we have one nihilist who confuses levels and derivatives in his claim that once GDP is no longer falling, all extraordinarily stimulative policies should be ended. Another who thinks there's something logically inconsistent in a model in which aggregate planned expenditure is greater than income, even though all of Milton Friedman's models were always of that character. Economists who don't understand that Robert Barrow's Ricardian equivalence, although it can apply on the tax side, does not in general apply on the spending side, except when what the government buys with its money is exactly what private consumers would have bought with the money had they had it instead. Eugene Fama does not understand the logical status of the savings investment identity, etc. Now, I don't think this is an adequate understanding of this particular current of thought. That people who are unfamiliar with the literature and do not do their homework will make mistakes. But why these mistakes? And why the tone? Ed Prescott says that and John Cochrane say that the idea that fiscal policy can matter for spending is a fairy tale that has not been taught to graduate students for a generation. And yet I look next door at Maury Obstfeld, who teaches that fiscal policy matters to really existing graduate students every year in the fall. Now, Maury Obstfeld is not terribly troubled by claims that the fiscal policy models of Obstfeld and Rogoff are fairy tales, and is not terribly troubled by the claim that the graduate students of UC Berkeley he teaches do not really exist. And most of the rest of us are untroubled by Ed Prescott's claims that we teach at a third-rate institution and are not advancing the science. And indeed, if Ed Prescott thought we were advancing a science in which the reason for the Great Depression was that Herbert Hoover was a socialist, we would be really worried. And why the certainty? I know that my confidence in my estimate of the strength and effectiveness of any of these extraordinary stimulative policies is relatively low. My confidence in the power of the fiscal multiplier is not great. It could be any number of things, ranging from 2 down to maybe it's 0 under some circumstances. My confidence interval for the effectiveness of banking policies and of quantitative easing is similarly large. Yet the nihilists seem to have a God-given certain belief that the impact of all of these extraordinarily stimulative policies is 0. And where does that come from? These are all questions I cannot answer, but still this is the best, this is the best that I can do for now. And it does put my conscience, somewhat at ease. So now this gets us to the current state of play. That I don't understand the nihilists. I think they will vanish because they have placed too many bad reputational bets that are now coming due. Right? The forecasters who track the stimulus package says that it did indeed add 3 percentage points to the growth rate in the second quarter of this year and is probably having the same effect in the third quarter. Countries that undertook larger fiscal stimuluses and did more to rescue their banking systems are indeed doing better than countries that are doing less. And so there are too many bad reputational bets where people are now rolling snake eyes and crapping out. And then when that happens, right, the 3-cornered cage match that I thought would begin a year ago will begin anew. That what do we know and what should we do later, in which Greenspanists, producerists, and punch bowlers go at it. And here I have a very hard time picking a side because I feel the force of all of their arguments. Indeed, I'm a repentant and not a completely or truly repentant Greenspanist. I still feel the song, and I still feel in some sense that he was right, that the subprime mortgage crisis should not have brought down the world economy. After all, the dot-com bubble saw investors in high tech and in telecommunications lose $2 trillion of wealth. How can $2 trillion of wealth be swallowed by the world economy with barely a burp, while $500 billion of wealth invested in subprime mortgages and lost can cause, right, the enormous but slow motion crash, right, that we see outside this room? It's a question. It's a hard question, and I don't have a terribly good answer to it. I do know that it's pretty clear how we should deal with this crisis, which is that we've reached a stage in which normal monetary policy, in which the Federal Reserve's open market operations, by which it buys bonds for cash, and thus puts more cash in the pockets of people, and as this cash burns a hole in your pocket, because after all you could be investing it in something more lucrative, you spend it, and that's the way the Federal Reserve boosts up spending, that doesn't work now. And that doesn't work now because the interest rates on safe assets are so low that you put cash in someone's pocket and ask them, do you want to spend it? And they say, no, I don't want to spend it. I'm happy having it in my pocket. And they say, do you want to move it into a higher yielding asset and trade it to someone else who will spend it, and then they'll say, no, I don't like any of the higher yielding assets. I've already lost 50% of my portfolio. I can't afford to lose the rest at all. You want me to buy bonds? Well, interest rates might go up and then the price of bonds will go down. I want to keep my money in cash because that way I know that it's safe. So the standard monetary policy tools that we use to try to control spending, well, they don't work, or at least there's a very large probability that they won't work right now. In which case, you deal with this crisis through a diversified strategy. That one of the first principles of finance is when you're uncertain, diversification is good. And so diversified stimulative policies seems to be a good thing to try. You don't know which of the alternatives you might put forward are best, so try them all at some level and hope that some of them work and reinforce success. So how do you deal with this crisis? First, by having the government guarantee existing assets, existing private risky assets. Government guarantees create more safe assets in the economy, and when the supply of anything goes up, in this case safe assets, their price goes down. When the price of safe assets like treasury bonds goes down, well, the interest rates on those treasury bonds go up. And as interest rates go up, people with cash in their pockets begin to say, hey, the treasury interest rate is approaching a normal level again. I should either spend this cash in my pocket or move it into some treasury bond. This is no longer the right thing for me to hold. And that will boost spending, that will push spending up and help pull us out of the recession. There's banking sector recapitalization. If you give the banks more money, then they won't be as scared of losses, and so their demand for safe assets will go down. And as their demand for safe assets goes down, well, that also lowers the price, et cetera, et cetera. It's a policy in the same sector, in the banking sector, but it's one acting on the demand for rather than the supply of safe assets. Third, you can eliminate expectations of future deflation. You have the Federal Reserve print up so much money that nobody thinks that prices could ever fall again on a large scale. And that will increase demand for real property and diminish demand for cash in your asset mix, which will get people to spend more. And there's expansionary fiscal policy as well. Have the government print up a huge honking additional tranche of government bonds, which are safe assets, to really expand the supply of safe assets out there. And so push down their price, push up the interest rate. By pushing up the interest rate, you make holding treasuries more attractive and so induce people to spend the cash. Now, all of these are kind of Rube Goldberg mechanisms, right? All of them are rather complicated ways of getting spending up, and we really wish we could use the normal way of getting spending up, which is simply to trade bonds for cash, get more cash in people's pockets and have them burn a hole in them and have them start spending it. The problem is right now we're in a situation where we fear that particular channel doesn't work. So we have to do something else. And these are all what the government has been doing, however imperfectly, however ineptly, right, for a year now. And you can make an awful lot of criticisms of the way things have been implemented. And you can point that all of these policies have grave risks. Government guarantees, well, produce moral hazard in the sense that people no longer have an incentive to guard carefully, to think carefully about what they invest in, to do due diligence, because the government's guaranteed it. We got into big trouble with the savings and loans because they had a government guarantee in 1990. We don't want to do that again. The government guarantee policy, which has the benefit of expanding the supply of safe assets, also creates bad incentives for the financial organizations that receive the government guarantee to then go out and do excessively risky things that the taxpayer will pay for in the long run. Banking recapitalization, well, that's a direct way of rewarding the bad actors. That is, I've lost 95% of the equity value of big bank, and now the government's going to give me more money to play with. That's not the way finance or any industry is supposed to work. If you lose money, the new investing resources are then supposed to go to competitors who have a demonstrated ability to gain money. Unfortunately, the only institutions with a demonstrated ability to gain money in the current environment are Goldman Sachs and JP Morgan Chase. And the belief was to let every other bank fail while the government pours all of the TARP money into JP Morgan Chase and Goldman Sachs, that would have produced an even worse world than the one we currently live in. That you had to prop up the weak sisters to some degree, or wind up with a gigantic oligopoly in which two enormous banks, enormous para-state banks, had made unbelievable fortunes for their CEOs and their top executives. No one really wanted to go there. Eliminate expectations of future deflation. Well, the obverse to that is you're creating potential expectations of future inflation. And we had inflation in the 1970s, and we didn't like it much. Expansionary fiscal policy. Well, the government needs, over the long run, to be taxing more relative to its spending, not less. And the task of moving from a world in which you spend more relative to taxes in the short run to the long run world in which you tax more relative to what you spend, well, that's a very delicate one, and you run the risk of starting with a stimulus program now and ending with a much larger structural deficit later. Given these risks and given uncertainties, how much of each of these extraordinary stimulative policies should we be doing? That's a hard question, but I think the clear answer to it is that we ought to be doing more. That is, unemployment rate nationwide is likely to be stuck around 10% or so for the next 15 months. It may be better, it may be worse, it probably will be. Forecasts are imperfect, the world never comes out like them, but it's as likely to grow above 10% as below. And the unemployment rate ought to be 5% or so. The unemployment rate ought to be 5% or so. So there's a sense in which we're on an unsatisfactory path and we should be doing more. One illustration, right back at the start of September 2008, Larry Summers, speaking for the Obama campaign, said that it was clear the economy did need, right, aggressive and extraordinary stimulative policies. And he carefully didn't put forward a number, but he did put forward a number for the gap, for the cumulative 3-year gap he expected to see between demand and what he thought normal employment demand would be. He said that was $900 billion. And if you think that filling half the gap is a reasonable goal for fiscal policy, given all the other things that are going on, that would imply a $450 billion or so fiscal policy stimulus package over 3 years or so. We actually wound up getting a $600 billion package, right? The 787 headline numbers deceiving. 180 of that are tax cuts for yuppies living in states with high sales taxes, which no one thinks will have any stimulative effect at all. So we went from $450 billion at the start of September to $600 billion when the Obama stimulus was enacted in February. But in mid-September, we had the collapse of Lehman Brothers and of AIG, and the magnitude of our problem doubled. That if a $450 billion stimulus had been appropriate before Lehman Brothers, a $900 billion would have been appropriate afterwards. And then in December and January, it became clear that the Lehman collapse was having bigger impacts than anyone had expected, and we were facing not just 3 months of complete economic collapse, but 6, which would say that you should double it again, that the right metric for how large the stimulus package should have been was on $1.8 trillion. Instead, we're winding up with $600 billion, which is kind of 1/3 of where we would really ought to be in the ideal world of economic policy technocracy. $600 billion is also a stimulus package that attracted 60 and only 60 senators, or 61 and only 61 senators to vote for it. And any bigger stimulus package would have failed to pass at all. And the response of the Obama administration is that $600 billion is better than zero, even if you do accept, which they say they do not, or at least not publicly, my arguments that it should be 1.8, should have been 1.8 trillion. What's going to happen in the future? Well, for the future, it really depends on which of the 3 live sides win the intellectual argument. win the intellectual cage match. The producerist side, the side that says we need to very tightly regulate finance, well, they have to deal with the fact that regulating finance means you're prohibiting voluntary transactions between adults who are supposed to know what they're doing. You're having the Federal Reserve tell people who want to lend and people who want to borrow that they can't make deals. You're telling people the Federal Reserve, you're saying the Federal Reserve is telling people who want to, let's say venture capitalists, they can't invest in high tech. There's a feeling that you try to run policies that tell people they can't do things in America, and those aren't politically sustainable. You won't get very long. And the argument against the producerist claim that high finance is a cruel hoax is that, yes, it's a hoax, but it's a more or less benevolent hoax. That the behavioral finance economists tell us that portfolio holders are excessively worried about risks and so are likely to adopt excessive caution. The behavioral consumer finance economists tell us that consumers are excessively greedy and impatient. And so a little deception, a little salesmanship, a little kind of, how about this complex derivative security to get you to hold a more risky and a longer run portfolio, that these really are in the interest of American savers, even though they wouldn't choose such things voluntarily if they had all their information. I don't know how powerful these arguments against the producerists will turn out to be. Intellectually, I find the second one to be stronger. Politically, I suspect the first one is likely to be the strongest. So I expect the producerist side to kind of go down and not to be very strong in the fight over what we're going to do. The arguments against Greenspanism, well, you know, shutting your eyes and saying it didn't really happen, we can ignore that. Pay no attention to that man behind the curtain. Pay no attention to that financial crisis and that recession we just went through. Everything's fine. It's not an attractive posture, and it's an even less attractive posture rhetorically than it is intellectually. You can make an intellectual case that maybe, just maybe, we should stand up and carry on as usual. I don't think you can make the case politically or rhetorically. I also expect the Greenspanists to go down. The arguments against the punch bowlers are that having the Federal Reserve worry not just about inflation getting too high, but also about asset prices getting too high, that's going to create extra unemployment. That is pushing asset prices down whenever the Federal Reserve thinks they ought to be a little bit higher. That's kind of when demand is not out of whack with aggregate supply. That leaves a lot of Americans without jobs for no reason other than we don't trust the financiers to control themselves and to behave rationally. And to say there has to be a better way to defend against irrational exuberance in financial markets than by attacking American workers. Nevertheless, I expect the punch bowlers in the end to carry the day, if only for institutional bureaucratic reasons. That this policy is one the Federal Reserve can enact on its own through its own internal decisions. That if it decides to move in this direction, Congress would have to block it and would have a difficult time doing so. And one thing that the subprime financial crisis is going to do is it's going to make the Federal Reserve say, let's never let that happen again. That just as the time since 1982 has seen a Federal Reserve say we are never going to let the 1970s come again, so the Federal Reserve will now say that we're never going to let the 2007 come again. So expect the future to see an American economy with somewhat higher unemployment, somewhat slower growth, somewhat lower asset prices, much more stable financial markets, and one in which the gap between our growth, our economic potential and economic actuality is somewhat larger. But at the moment, I see no way of avoiding this, because I see no way of making either of the other two positions more attractive, either intellectually or politically and rhetorically. And with that downer message, let me stop there, and thank you all very much. I'll be happy to take lots of questions.
Sure. Okay.
Yes. I'll take questions until the cows come home. Or the chickens come to roost.
If you want to ask questions, the students are there with microphone. Raise your hand, and they will go to you.
Yes? Hi.
So, with your comment about models, why does it appear that economists fall in love with their models and that they never back away from their stance of what their models are telling them? And then two, at what point do you say, all right, there's too much chaos in the markets now, maybe I should try to adopt a new strategy versus building empirical models?
Well, we're trained to be aggressive, right? It's a discipline where being aggressive is regarded as a good thing. The standard story for that comes when Christina Romer presented her first paper from her dissertation, which turned out to be a declaration that an elder professor at Wesleyan, Stan Liebergott, had gotten his entire historical series on unemployment rates wrong by taking a couple of shortcuts in making approximations and extrapolations that turned out not to be the case when she checked them on modern data. And as other people remarked, if you do this in sociology or history or English, you're then toast. And yet the economists all applauded it and said, good job, game way. She's probably right. Wow, this is someone to watch out for. So some of it is an internal mode or valuing of aggressiveness within the intellectual community, that taking on someone older and respected aggressively is regarded as a sign that you know what you're talking about and are at least worth listening to. As to our trust in models, well, it's what we know, right? For the most part, economists know much less about human interactions than psychologists, know much less about social patterns than sociologists, and know much less about, say, historical analogies and tendencies than do historians. If the models aren't worth very much, then why have them at all? Right? Why not have financial markets studied by sociologists? Say, like one at the University of Edinburgh, I believe, who's just written a brilliant book called An Engine, Not a Camera, about the efficient markets hypothesis. So in some ways, we're trapped with our models because that's all we know and our only reason for being. Yeah?
So would you recommend, we have lots of undergraduates here, become a history major?
Okay.
Economics.
All right. I'm afraid I can't, right? Back when I was a first semester junior, I was actually an interdisciplinary social science major, having been scared out of physics and engineering by my high-powered physics and engineering roommates, who insisted on doing things like dragging me to the general relativity course and making me sign up for it pass-fail on their ends of, come on, it'll be fun. I got 1.5 questions out of 6 right on the final, which was a C. Of course, on the other hand, Seth Lloyd, who's now muck-a-muck professor of something or other at MIT, only got 3 questions right out of 6 on the final. It was a hard exam. But at any rate, in the first semester of my junior year, I wound up on a faculty search committee for assistant professors in X and social studies. And I noticed that the people who were coming in to apply for jobs as assistant professors in economics and social studies were 25 years old and all had 1 article written and promised they'd finish their dissertation real soon now. While the people coming in asking for assistant professors of history and social studies all had written 2 books, had published 8 well-regarded articles, and were expected to be paid $10,000 a year less than the economists. And at that point, it seemed to me to be immoral not to respond to market forces. And so I headed for economics, right, rather than for history. So. Okay, more questions? I can lecture for an additional 15 minutes about the capital asset pricing model if anyone wishes. And the equity premium, the future of the equity premium. No?
Well,
Yes?
I will ask a very irreverent question that only a director at the Schulterbach Board would dare ask. There have been many articles written that the Nobel Prize in Economics should be abolished. That the Nobel Prize in Economics should be abolished. Would you defend the Nobel Prize in Economics, after all, which originated long after all the other Nobel Prizes?
I remember the movie Shakespeare in Love, right? When the actor, I forget the name of both the actor playing it and the actor whom the actor is supposedly playing. But whatever, the leading man of Shakespearean times. The one who they persuade to play the role of Mercutio in Romeo and Juliet by telling him that the play is going to be called Mercutio. And he stands up and he demands that everyone sit down and be silent and leave, and then he turns to one man and says, who are you? And he says, I'm the money. To which the answer is, then you may stay. But try not to talk too much. I think that if we didn't have a Nobel Prize, not a Nobel Prize, but a Nobel Memorial Prize in economic science, right now, I think it would be very difficult to persuade anyone to implement it right now. I think people would say, why is this a good idea? Aren't we functioning well in and of ourselves? I would say that there's definitely a place for a Nobel Memorial Prize in social science more broadly. You know, as the Economics Nobel Prize has occasionally noticed in reaching outside for sociologists and psychologists, although not too often. If I were running the Swedish Academy right now, I would take the bull by the horns and broaden, the description of the prize just by my own say-so, and say we are going to consider anyone who studies the kind of socio-economic world as eligible for this prize, rather than confining it to this relatively narrow sect of economists. Especially because if you take away the economics Nobel, then Berkeley loses half of its Nobel Prizes. And the chancellor has to change all his speeches about how many Nobel Prize winners there are on the campus, and I don't really want to make him do that. So. Yeah?
Throughout your discussion, Dr. DeLong, you alluded to all these crises, panics, et cetera. Are they an inevitable feature of capitalism in your view? Is there any, and so that's part A. And then part B, is it worth it?
I wouldn't so much say that they're an inevitable feature of capitalism as that they're an inevitable feature of human psychology, given who we are and what we do. That is, the problem is that when a whole people pile into an asset class, its price goes up. And when its price goes up, well, people can have two reactions, one of which is, geez, this is expensive, I don't need any of this. And the second reaction is people who invested in this in the past did well, therefore I should invest in this in the future. That kind of imitating things that have done well in the past is the way to do well in the future. The first way is kind of how you deal with, say, buying automobiles or washing machines. You go to buy an automobile or washing machine and they say, oh, we just sold out, but we could get one for you at double the price. You're likely to say, nah, I'm going to go off and I'm going to do something else. I know why the price is high. The price is high because demand's exceeded supply. This isn't really worth it. In financial markets, that doesn't seem to work that way. People instead say, so-and-so has followed a successful portfolio strategy, therefore I must follow the same strategy, or I should follow the same strategy. And in a way, I suppose this is adaptive, right? That back on the African plains, when you have all 100 humans kind of sitting there, newly invented language, talking about what to do, well, pretty much all 100 had pretty much decided whether to head for the trees to look for nuts or to head north for the water. Because if they split, then the leopard's going to get somebody. But if you all stay close together, if you herd, and we are herd animals, then you stand a better long-run chance, right? That we are, in some sense, designed to be social animals, which means that we're designed to be herd animals, which means that when you apply it to financial markets and to people's opinions about the worth of different investments, you're going to find people herding all over the place. And it's this basic herd behavior, the fact that we talk to each other and then tend to think like the people we talk to think, that is at the root of these episodes of irrational exuberance and irrational pessimism. And I see no good way to get rid of that in human psychology. The most successful investor of the past century, Warren Buffett, said he was going to eliminate that by moving to Omaha, right? And never talking to anyone in Manhattan. And by not talking to anyone in Manhattan, make sure that when he decided to buy, it was for some good reason and not because he was picking up a trend and was the last person in the herd to buy and thus buying at some overpriced. But now Warren Buffett is at the center of the largest kind of herding of let's follow Warren Buffett's portfolio strategy ever seen. As happens every spring when there is a grand Berkshire Hathaway convention in Omaha, Nebraska, to celebrate Warren Buffett's achievements, where lots of people try to figure out how to imitate him. And when the very attempt to avoid herd behavior, in fact, triggers an extremely large episode, an example of it, all you got to say is we're in trouble. So, be extremely cautious, always. And always wonder why you're doing things. Take a look at your own psychology, because after all, always ask the American question, right? The question of, if it's such a good idea for me to buy this asset at this price, why is this other person selling it to me, right? Do they know something that I don't? And rather than trying to drum into financiers and financial professionals every day, every hour, every minute that lesson, I don't know what you can do. And so I think we'd have the same things happening under any other alternative social system. They would just take different forms. So, yeah.
You said that you think that the unemployment rate would be somewhere around 10% for
a while,
one
yes.
year or 15 months.
Yeah.
So given that, and given that the natural rate of unemployment is somewhere around 5%, so to bring down that 5% unemployment rate, be using Okun's law, coefficient either 2 or 3, then you are looking for at least about 10 to 15% increase in the level of GDP, which given the $15 trillion amount of GDP now, we are looking for an output gap to close, which will be somewhere between $1.5 trillion to $2 trillion.
Yeah.
Given that you have very low degree of faith in or the confidence in the value of fiscal multiplier, what do you think would be then the new stimulus package?
Larry Summers' line is that Okun's law is breaking down in this recovery, and that the administration forecasts of output have been doing pretty well. It's administration forecasts of unemployment that have been doing badly. And that's because the Okun's law coefficient is significantly less than the 2 to 3, and thus that the gap is about half as large, as you're saying. But yes, that the elementary math does seem to require another trillion. Right? That, as I say, the 1.8 trillion rather than 600 billion as the right number to have done in an ideal world does seem to make sense arithmetically. Whether it makes sense in some broader model, right, is less clear. That after all, this arithmetic only applies as long as the value of the deficit doesn't cause a panic and a collapse in confidence in the dollar as the safe asset in the world economy. right? So far, there are no signs of such a collapse in confidence. But if there is, then all bets are off, and an additional $1 trillion of bonds might well produce such a thing. So. All right, well, thank you very much. Hope that was what you were hoping for.
Thank you very much, Dr. DeLong. From all of us, thanks a lot for coming to Scranton. And to all of you, we'll see you next fall. Thank you.